Hi everyone. I'd like to do a deeper dive into the top 10 high-yield dividend stock watchlist. You're likely familiar with seeing the final product, which is the formatted list of the 10 stocks that are chosen to be on the watchlist every month. I take a screenshot of this Excel file and upload it to Patreon, and then I write a Seeking Alpha article that provides a slightly deeper update. But there are many more things going on behind the scenes, and I thought it may be useful to show you how this entire process works. Let me start by unhiding all of the columns and rows in the top 10 list for August. As you can see, there is quite a lot of data that is hidden. It doesn't even fit on my screen here. Let me spend a minute explaining all of this data and going over exactly how I put this watchlist together each month. The raw data you're seeing here all comes out of the Schwab Stock Screener, and then I have a few additional columns of my own that help me make the top 10 selections each month. The first column that contains a formula is column J, and it computes the over or under valuation for each stock using dividend yield theory. The formula I like to use may differ from other online sources. I prefer to compute the fair price for each stock using the dividend rate divided by the 5-year average trailing dividend yield. Both these data points come directly from Charles Schwab. I then subtract the fair price from the actual price and divide the result by the fair price. So if the actual price is lower than the fair price, the valuation figure is a negative percentage, and this implies the stock is potentially undervalued. If the actual price is higher than the fair price, the valuation is positive, and it implies the stock is potentially overvalued. Next, I'm going to jump over to the last 4 columns, and this is how I rank all of the stocks. If you have read any of the articles from Seeking Alpha, you may recall that the objective of the watchlist is to identify stocks that have the best combination of quality and value. Here is exactly how this process works. It starts with a quality score for each stock, here in column AB. Each stock receives a score out of 10 based on their financial metrics. Let me go over the point system. Each stock will receive 1 point if they meet the following conditions: a payout ratio of 50% or less, if it has a wide moat rating for Morningstar, if it has an exemplary rating also for Morningstar, if it has a 3-year dividend growth rate of at least 8%, if it has a 5-year dividend growth rate of at least 8%, if it has a 3 and 5-year revenue growth rate of at least 8%, if it has a 3 and 5-year earnings per share growth rate of at least 8%, and finally, if it has a return on invested capital of at least 12%. These conditions are very tough, and they are purposely set to be very tough, because I want the stocks that meet many of these conditions to rank much higher than the stocks that meet few of these conditions. Once each stock has a quality rating, I then sort the data by the quality rating in descending order, with the second sorting criteria being the 5-year dividend growth rate. Then I assign the stocks a quality rank from 1 through however many stocks appear on the full data file. In August, this happened to be a total of 34 stocks. You can see the quality ranking in column AC. Column AD has the value ranking, and this one is a bit simpler. I sort the file by the over or under valuation in ascending order, again with the 5-year dividend growth rate as the second sorting criteria, and I assign each stock a value rank. Then in column AE, I combine both rankings and again sort the entire file by this column in ascending order, with the 5-year dividend growth rate as the second sorting criteria. The objective here is not to find the highest quality businesses or the cheapest stocks, but the best combination of both, high quality and cheap. You can see SiriusXM ranked the best overall in August. It had the second highest quality rating and the best valuation rating. But if we look further down the list, we can see Paychex as the 10th best stock with the highest quality rating, but a pretty poor ranking of 22 for valuation. So even though Paychex looks less attractively valued than 21 other stocks on this list, its high quality pushes it ahead of some of the more attractively valued stocks. I think you get what I'm trying to do here. If you recall the actual top 10 list for August, Paychex was not amongst the 10 selected stocks. That's because there is one additional step to this selection process. Once I have the stocks sorted in order of the most appealing, I want to determine what type of return these stocks can deliver in the long run. Just because a stock is cheap or looks great doesn't mean it will keep growing at a rate that can deliver a strong return. Columns W through Z is where I try to estimate the potential long-term return for each stock. This estimated return is based on 3 components: the forecasted earnings growth rate, the potential return to fair value boost, and the dividend yield. The forecasted earnings growth rate comes directly from Finviz. I look up all of these stocks on the website and copy over the projected earnings growth rates from analysts. The dividend yield is also fairly straightforward, as it's the computed dividend yield from the data that comes directly from Schwab. The third element, the potential return to fair value boost, is my own formula. I take the over or under valuation from column J, and I annualize it over a 5-year period. This requires making the assumption that, for example, if SiriusXM is in fact 62% undervalued today, that it will return to fair value over a 5-year period of time. If I assume this can happen, then what impact will this have on the stock return? Well, in SiriusXM's case, it would be a 10.16% annual boost in total return. So the expected rate of return is the sum of these three components, with the exception of applying a margin of safety to the forecasted earnings growth rate, where I essentially assume the stock can grow its earnings at 75% of what analysts are projecting. Analysts get these forecasts wrong all of the time, so it doesn't hurt to give them a marginal haircut. And after this part is completed, I go down the list from top to bottom and I select the 10 highest ranked stocks that also have a potential expected return of at least 12%. So as you can see, I skipped over Hershey since its projected return was only 9.11%. I also skipped Essential Utilities, PNC, and Paychex, and a few more stocks along the way. I realize these expected returns are probably not overly accurate, but I prefer to invest in stocks that at least have the potential to deliver on my 12% return expectations. This watchlist has been around for 45 months now, so almost a full 4 years, but it has evolved since it has first started. The first 10 watches or so were not limited to selecting the top 10 stocks. I simply included all of the stocks that passed the initial screener on the list. The initial screening process, however, has not changed since inception. I still screen for the same 10 criteria within Schwab's stock screener. A dividend yield of at least 2.75%. And I know some of you don't consider that to be a high dividend yield, but I for one do. I think setting this yield threshold at this level also allows this watchlist to catch a few high growth dividend stocks when they see their dividend yields creep up a little and make them look pretty attractive. One notable example was Broadcom, that currently has a yield of less than 1%, but at one point it popped up on this list and actually remained on it for a few months. I also want stocks that trade on the New York Stock Exchange or the Nasdaq. I look for payout ratios below 100%. I look for positive 5-year dividend growth rates. The market cap threshold is set to a minimum of $10 billion. I screen for a wide or narrow economic moat, a standard or exemplary stewardship rating, a B+ or better S&P quality rating, and a positive 5-year revenue and earnings growth rate. Typically, the screener will find between 30 and 40 stocks each month, with not a whole lot of turnover. In total, there have been 88 unique dividend stocks that have appeared on the watchlist. I imagine if I didn't filter for only the top 10 stocks, there would be a handful of more companies on this list. I track the overall return for the watchlist because I'm curious how it's performing relative to comparable benchmarks. The best benchmark is an alternative investment you'd make if you weren't following the strategy that you are. For that reason, I think Vanguard's high dividend ETF, ticker symbol VUIM, is a good proxy benchmark of an alternative high yield option. I also like to compare to the S&P 500, which is a good proxy for how the overall US equity market is performing. And here I track the returns for SPY, the Spider S&P 500 Trust ETF. As you can see thus far, my watchlist is performing quite well relative to both benchmarks. On an annualized basis, the watchlist has a CAGR of 17.42% versus 16.68% for SPY and 16.19% for VUIM. That is a phenomenal return for VUIM over the past 45 months, if I may add. Definitely better than the ETF's longer-term performance. But this watchlist return, while interesting to look at, is a bit useless to you as an investor. Rotating in and out of the top 10 stocks each month is not a practical dividend investing strategy to follow. You certainly don't want to apply it in a taxable brokerage account, as the tax drag would be quite high. So I decided to test the success of this watchlist in another way, one that may be more beneficial to individual investors. I tested it across the board on all 88 stocks. Here is what I did. I assumed that I would invest an equal amount of money, $10 in my test example, into each stock each time it was on the top 10 list, and I would hold this position forever. So if a stock appeared on the watchlist twice, I would add $10 each time, and so on. I wanted to see how many of these stocks would leave you with a positive overall gain, and the data was analyzed through month-end July 2024. Out of the 88 stocks that have appeared on the watchlist, 77 would have led to a positive gain had you invested $10 each time the stock was on the top 10 list, which means that 11 stocks would have led to a loss as of month-end July. That's an 87.5% rate of success, which I think is pretty great. Some of the individual gains are certainly better than others, but I think investing in a stock with an attractive yield and having a positive return all the while collecting a growing income stream is not a bad place to finish. The second test I ran was on the stocks that appeared on the watch list more frequently than others. In total, there were 23 stocks that appeared on the top 10 list at least 10 times. So if you were investing $10 each time a stock was on the top 10 list, you'd invest considerably more money into the stocks that appeared on the list more frequently. Out of these 23 stocks, 21 would have a positive overall gain as of month-end July. That's a 91.3% rate of success. That being said, I would not recommend for anyone to blindly invest in all of the stocks that appear on this watch list. Its main purpose, at least for me, was to generate a short list of stocks for me to consider adding to my portfolio. I used this list extensively in the past, but not so much anymore. Today I prefer to invest using the 4-factor strategy that is proving to be quite successful as well. I continue to update and share this high-yield watch list because I think it still provides value for some of you and my audience in Seeking Alpha. Another benefit of me continuing to run this watch list is that I can capture all of this data, and then I can go back and analyze certain aspects. One thing I'm looking forward to testing is how accurate the projected earnings forecasts from analysts are. Once the watch list goes beyond 5 years, I'll be able to start testing how effective my expected rate of return is, and perhaps I'll find some things that can make it better. I hope you enjoyed this deep dive behind the scenes of the high-yield watch list. If there is anything specific you'd like me to expand on, please don't hesitate to ask.